732-505-1160 is the call-in number. Let's go to our first caller of the day, which is Bob in Ortley Beach. Bob, how are you? Good morning.
Hi, Lou. Good morning. Great show. Thank you. I'm so glad you talked about reverse mortgage because I went through the same logic that you just put out. And boy, when I mentioned it, I tell you, 100% of the people must have said, no good, you're going to you're going to lose your house, they're going to take this, you're going to pay insane interest, blah, blah, blah. Okay? And I said, you know what, I'm going to do the research myself, which I started to do. And I still haven't found where the gotcha is, okay? Maybe a couple of quick questions. Okay, so the money you take out, that's not reported as income, correct?
Correct. Another advantage.
Oh, man.
It's not considered income for anything. It's not considered income for any benefits that you're getting, like PAD or property tax freeze or anything like that. So it's your own money. Just think about it. It's your own money. The equity in your home is your own money, just like a savings account is your own money. Just because you take money out of that savings account or the house, that doesn't mean you have income. Now, if it earns interest, look, a lot of people, what they were doing in the past is taking lump sums out of their house because interest rates were low on the reverse mortgage and there's no payments on them, and then investing the money for income. All right, so here they are, they're just taking it where their house is paying for them. You could do that directly from the house, too. Or they use the money to pay off debt, which is great. So by doing it through the reverse mortgage, you avoid taxation, income taxation, capital gains taxation if you had to use securities to fund your life. There is no gotcha there, Bob, and you're right. Now, I'll tell you, I don't want anybody getting a reverse mortgage if they don't feel that they're going to be in that house for at least 5 years. All right, or the rest of their life, because the fees to set it up are high. All right, they're lower than they used to be. But that was
my next question. Go ahead.
That's the negative. You have to buy insurance. All right, from and it's 2 or 3% of the amount of the loan, and that is to prevent your estate from owing more on the mortgage than the house sells for. So here's an example. My dad and mother had a reverse mortgage. The reverse mortgage, and my dad and mom took it 18 years ago. My dad passed away a couple of years ago. And now this reverse mortgage...
Sorry to hear that.
Thank you. The reverse mortgage now is worth more than a house can sell for. All right? About $20,000 more than a house can sell for. All right? So there was nothing there. We were able to just sell the house and give the keys to the bank, and that was that, because they paid insurance at the beginning that the estate can never own more, or they can never own more on the loan than a house sells for. So I don't care if the loan's $150,000. If the house sells for $120,000, that's it. It's over. HUD pays the bank the difference, and everybody's happy. So that comes out. So if you're going to take, and plus initiation fees, all the fees that go into any kind of mortgage or loan. So maybe it could be $5,000, $8,000, $10,000, depending on the size of how much you take out and how much equity you have in your house. So if you're going to sell a house 2 years from now, you're not going to take the home equity. You're not going to take the reverse mortgage and have all. Now you don't pay those fees; they just get rolled into the loan. But ultimately, you're going to have to pay it when the house is sold. So that's a negative right there. But and if you have other assets, that's the last thing you want to do. The reverse mortgage is for people who have nowhere else to turn. It's the last thing. And I've had clients. I've had clients who run out of money in their investments, and I've always told them, look, you'll be fine. Once that happens, we're going to get a reverse mortgage on your home. You're not going to be destitute. You have a lot of equity in it, and we'll start that once you run out of money. So that's the last thing we always look at. If someone has $100,000 or $200,000 portfolio, I'm not going to put a reverse mortgage on their house.
Right. And you could take out so much per year, right?
There's three different ways you can take the money out.
250. Okay.
No, there's three different ways you can take the money out, and you could do it in a combination. You could take a monthly income. All right. They'll give you X number of dollars per month into a pool of. So what they'll do is they evaluate your house, and they'll say, okay, based on your age, and this amount can go up every year, you have a borrowable pool of $200,000. How you take it is up to you. You could take it as a lump sum. You could take it as a credit line and just get the money as you need it, just like a regular credit line would go. Or you could take it as a monthly income. or a combination of the three. You could take out a lump sum to pay off your car payment or your traditional mortgage, and then get a monthly income on top of that. So it's very flexible.
Financial thing, man.
It's great. Okay. Especially if you don't care about inheritance for your kids. It's your money. Spend it all.
The only one that agreed was my son. He said, Dad, live abundantly. Take the money out and enjoy your life. Okay? I just turned 70. So that's why I'm back on this. I'm so glad you're talking about it. The only other thing is they look at credit scores and all of that.
The only reason they look at your credit
score, and my wife is iffy.
Well, all they care about is your ability to pay the real estate taxes and the insurance on the property. Okay. And the HOA fee if you have a retirement community. Right. All right. That's why they're doing the credit. They never used to do the credit score because you never had to pay it back, right? Who cares what your credit is if you don't have to pay it back? But they want to make sure that the house doesn't have a tax sale against it because you don't have the funds to pay the real estate taxes. So even if your credit rating isn't that great, they're going to look at your income and your ability to pay the minimal amount you'll have to pay on the home to maintain it.
All right. Fantastic, Lou. That was great. I hope, I'm sure there's a lot of listeners today that have really piqued interest. I mean, it's almost a no-brainer.
It's like I said, it's totally wrong for certain people, and it's a lifesaver for others. And I don't think I've ever seen a financial tool in my entire career that changes lives to the extent that a reverse mortgage can do. Their financial life.
Just want to say this before you get on with your show, but you know what? When someone like you, with your reputation, integrity comes on and says that, like for me, that made all the difference in the world. So thank you.
All right, and anybody out there that wants to know if a reverse mortgage is appropriate for them, come meet with me. Have a consultation with me. Let me see what your situation is, and I'll be brutally honest with you. I'd say I'd wait. I wouldn't do it now. I would say, and I'll show you. How it'll change your life. I'll do the figures, and I'll show you, look, this is what it means for you to do this. And I even have, and I get no financial reward from it. Even in my office building, there's people that we deal with that do reverse mortgages, so I'm even involved in the process with you. I don't charge you for it. I don't charge for any services regarding reverse mortgages. I just advise you, and I point you in the right place, and I answer your questions during the process. Because I'm a good guy.
Wow.
That's what I do. I mean, so don't hesitate to talk to me about a reverse mortgage because you think it's going to cost a lot of money. And I'm going to charge you. I'm going to charge you anything to do that. And everybody should get advice before doing it. Don't willy-nilly go into it or don't not go into it. Talk to somebody who knows the ins and outs of it and could demonstrate to you the pros and cons of doing it, and then you make a decision with guidance. Bob, thanks for the call. I'm glad you called. All right. Did you get it? Did you get the reverse mortgage yet? Oh, he left. I wanted to know. Hey, Bob, if you didn't get it yet, call me once you do get it and tell me how the process was for you, and if you regret it or you're happy that you did it. All right, 732-505-1160. Let's go to Bill in Toms River. Bill, how are you?
Hey, Lou, how are you? I don't know whether this is in your expertise or not, but it's a problem I got to ask you. An elderly relative, widow of mine, just got a notice from the water company that she owes $500. Now, she paid the bill consistently month after month, and now they determined the meter was wrong, and this is why her bill was low. And now they're billing her for $500, and I don't know how they arrived at that figure or whether they can legally do that. The meter is their business.
No, but the fact is that if you're paying a certain amount for a certain amount of gallons of water and they made a mistake or the meter was inaccurate, they have a right to come back to you and say, we miscalculated you. The same is true happens in like your electric bill. They don't read your meter every month. So what happens is they average your cost out, then they read the meter, and if it's over, you're going to get a surcharge on a bill in the future. It happens all the time with utilities. So certainly it's legal. It's upsetting. Nobody wants an unexpected $500 bill, but most likely, and I'm pretty comfortable in saying this, that the water company is totally accurate and realized that they had undercharged her for the amount of water usage, and therefore she owes the difference, and I don't think there's any way around it.
Okay. I just needed that advice from you. And I know the water company, when they bill you anyway, they don't do an exact reading. They bill in the closest 1,000, and they round it off. So your bill may be low one month and higher the next because the rollover amount gets added onto it. Mm-hmm. I know that for a fact.
But the bottom line is, at the end of the day, over the course of the year, for the usage that you had, whether it's electric, whether it's natural gas, or whether it's water, you'll pay for the amount you use. You may not pay for it as you go because of the adjustments that are made due to meter readings, but that's the norm for utilities. And unfortunately, like I said, it's no fun to get a bill in the mail that you didn't expect, especially if you're tight. But it is what it is, and there's no way around it.
Okay, Lou, I appreciate your advice. I didn't think you would handle it, but I appreciate it. It's a great insight.
All right.
Thank you very much.
All right, Bill, my pleasure. All right. Americans saw a number of changes to their retirement savings plans when we had the Setting Every Community Up for Retirement Enhancement Act. You got to love the names of these. Because they wanted to get the acronym SECURE. So they figure out, how do we word this act to make it called the Secure Act? So it's Setting Every Community Up for Retirement Enhancement Act. It'll never be called that. It'll always be called the Secure Act. Well, it was passed 2 years ago, and there's going to be more changes to retirement planning. The House Ways and Means Committee recently approved a second bill, the Securing a Strong Retirement Act of 2021, that will continue to tweak the rules for contributing to and withdrawing from retirement savings accounts. The nickname of this one is Secure Act 2.0. And really what it does is it amends kind of the previous act by adding some things to it. And it has bipartisan approval. So this is something that's going to pass. Whether it passes this year or it's going to be pushed off to 2022, I don't know. But I'm very comfortable that this is going to pass Congress. It's one of the few things that are bipartisan in Congress these days, and I don't see how it doesn't pass. It's sponsored by Reps Richard Neal, who's a Democrat from Massachusetts, and Kevin Brady, who's a Republican from Texas. So you can't get more bipartisan than that. So let's see what's in this thing here. All right. One of the important things I find here is the increase in the required minimum distribution age. Last year it was moved from 70.5 to 72. The proposed legislation would raise it again, this time to age 75. Over a decade. It's not going to happen overnight. That means you could have more time to grow your money tax-free by delaying your retired minimum distributions. But your withdrawals may be larger, and this is part of the act that I don't like. Instead of just pushing it off to 75, they want you to be able, once you start taking those required minimum distributions, to take out a lot more per year. So that's a negative there. But at least it buys you more time if you decide to do that. Other things in here, legislation would require employers to automatically enroll eligible workers into a 401k or 403b plan at a savings rate of 3% of their salary and increase that 1% until their contribution reaches 10%. Now, you're not obligated to do this as an employee. You could opt out and say, hey, I want to take home all my money. I don't want any of my money to go into 401k. But what this does is it does it automatically for you. For now you have to do something to stop it, as opposed to actually doing something to start it. We're lazy. So some of us may not have the inertia to go and set it up. Well, we'll automatically be set up in it when we join the company, and then if we want to opt out, we could opt out. And I think this is a good thing. Anything that has people save for the retirement is a good thing. Let's see, catch-up provisions. Currently, if you're 50 or older, you could put $6,500 more into a 401k over the $19,500 limit. You could put $7,000. You could put $1,000 more over the $6,000 limit for IRA accounts. Workers between 62 and 64 would be able to contribute even more to these accounts. The 401k and 403b, you could put an extra $10,000 in if you're over 62. The IRAs, the catch-up limits for those 50 years and older would be indexed to inflation starting in 2023. And inflation is going to be a big deal, so it's going to be increasing a lot, I think. There's some other things in here, too. Currently, simple and SEP IRAs are not allowed to accept Roth contributions from employees. The proposed legislation would change that. While other retirement plans like 401ks and 403bs do allow Roth contributions. Now, what's the difference? The difference is taxation. If you have a traditional 401k, the money's going into that 401k before taxes are taken out. So, in essence, you're getting a tax deduction for the contribution. And then when you take the money out, all of it's taxable. In a Roth, you're putting in after-tax contributions. You're paying tax on the money first and then putting it into the 401k or the 403b or the IRA. Now, it's a little more painful because you're paying taxes as you go. And if you're in a high tax bracket, that may not be the wisest thing. But when you take the money out, it's tax-free. And there's no required minimum distributions on Roth accounts. Why is this important? Because a lot of people pay tax on their Social Security because of the income that comes out from required minimum distributions or just regular distributions from IRA accounts, traditional IRA accounts or 401k accounts. By having a Roth 401k or a Roth IRA, you'll never be forced to take the money out. And if you do take the money out, it comes out tax-free and it's not going to affect your tax return. I have a lot of clients that once they start hitting their required minimum distribution, they're taking out $30,000 or $40,000 from their IRA. They're forced to, and that's causing 85% of the Social Security to be taxable. So, Roths, in the long run, the Roths are the better way to go. And the younger you are, the better it is, because you're accumulating more tax-free money over the course of your life. In traditional IRAs, it's tax-deferred, not tax-free. You don't pay tax when you earn it. You pay tax when all of it comes out. Part-time workers would have a shorter path to retirement plan eligibility. If you work 500 hours or more for 3 consecutive years, you can contribute to a retirement plan. The proposal would reduce the 3-year rule to 2 years. And there's some other tax credits for small businesses and so forth that are planning on setting them up to give you an incentive to do so. Let's talk taxes. Taxes officially ended on this extended tax season last Monday, May 17th, to the joy of accountants like myself who hate 2 years in a row of having extended income tax seasons. And, of course, a lot of our clients came in up to the last day, which was irritating. But that's beside the point. What about those who had unemployment? They changed the rule mid-season through one of the stimulus acts that the first $10,200 of unemployment payments in 2020 was no longer taxable. And you could double that if you're married and you both got unemployment. So a lot of people had filed their taxes early before this act was passed. And they paid tax on the whole amount of their unemployment. Now, the IRS announced last month not to amend your returns, that we're going to figure it out ourselves. And we're going to refund to you those taxes that you paid that you shouldn't have paid. And the IRS has identified 10 million tax returns, 10 million people who filed their tax returns before the plan became law, and is reviewing those returns to determine the correct amount of tax on their unemployment compensation. Now, the refunds are going out. They're starting now. They're starting now. And they're going to do it in 2 phases. First, it's going to start with returns from single taxpayers who had the simplest tax returns, like people who didn't claim children as dependents, or had any refundable tax credits, because all these things changed with that. So they don't want to deal with that right now. They want to just deal with a simple single tax return where somebody claimed income from unemployment that they shouldn't have claimed, and we're going to give them a refund. After that, then it's going to adjust returns for married couples who file jointly who are eligible for an exemption of up to $20,400, and then others with more complex returns. Now, this only applies to unemployment benefits in 2020. In 2021, you're going to have to pay tax on all of them, unless they change the law, who knows. But right now, this is a one-time thing for coronavirus. Now, in some states, if you're not from New Jersey does not tax unemployment benefits, but some states do. So if you live in a state that taxes unemployment benefits, you have to investigate whether or not they're not obligated to. They're going to exempt $10,200 as well. Most likely, they're probably not. So don't expect a refund from them, but you'll have to see what the story is there. So if you're entitled to a refund, the IRS will directly deposit it into your bank account if that's the way you usually get your refunds and you provided the IRS with bank account information. Otherwise, they'll send you a check. They're also going to send you a notice explaining any of the corrections. You want to keep that with your tax records. They're going to send that to you 30 days after the correction is made. Now, should you file an amended return? The IRS is saying unless you have other refundable tax credits, like earned income credit, that would be affected by having $10,200 less in income, you don't need to amend the return. But if you are going to get more credits, in addition to saving income taxes on the $10,200, you're going to want to amend the tax return. I have a family member that was the case. They got a lower earned income credit because their income was higher. The earned income credit is a refund that you get that the government gives you over and above your own taxes paid. Even if you had zero tax liability, you had no taxes withheld, it's a welfare payment, basically. And the amount you get is based on where your income comes in. The sweet spot's like around $25,000. So if you're at $35,000, you're going to get less of an earned income credit than you would if you had $25,000. So by lowering your income, because $10,200 of unemployment is no longer taxable income, your credit would go up. And you need a refund of the credit as well as the refund of income taxes. So in that case, where you have a more complicated situation where there's a lot of moving parts, you do want to amend the return. And that's exactly what I did. Now, keep in mind that, a lot of people got unemployment last year but didn't withhold any taxes. Either they were new to unemployment and they didn't know that unemployment is taxable income, or they just wanted to get as much money in their life as they could during the coronavirus. And then they do their taxes and they find out they own a ton of money. I got people coming in with $25,000 in unemployment last year. Thankfully for them, the first $10,200 is forgiven. At first, it wasn't the case, and I had people, looking to write checks for $7,000, $8,000 in taxes. So if you don't want that kind of surprise in your life, you could withhold taxes on unemployment. I tell people, withhold 10%. And then when you get your 1099 from the state, you will see that you have taxes withheld. Are you eligible for the new child tax credit? Well, the new child tax credit kicks in July 15th. What is it? If you have a child that is under 6 or children under 6, your tax credit has gone from $2,000 a year in 2020 to $3,600 a year in 2021. If you have a child between 6 and 17, your tax credit goes from $2,000 to $3,000. And the way the IRS and the government want to do this is they want to prepay part of it through monthly direct deposits starting July 15th. And this will be based on your tax return you filed last year. So say you have 2 children, 4 and 5. You're going to get $300 a month directly deposited in your account for each child. And there's no limit to how many children you can have. You have 10 children, you're going to get $3,000 a month deposited. Well, you can't have 10 children under 6 unless you're an what do you call it, octomom? But there's no limit to it. Now, if your child's 6 to 17, you're going to get $250 a month. And you'll get the rest of it on your tax return next year. So you're going to get 6 months of $300. That's $1,800 of the $3,600, and then the difference you'll get as a refundable credit on your tax return next year. This is basic income, is what it is, people. Let's face it. This is going to be permanent, I guarantee you. You don't give people $300 a month direct deposit for each child in their account and then take it away from them. No politician has the castañas to do that. The political castañas. I think I just coined a new phrase. They're not going to take it away. So this is great for families with children, especially young children. My kids love this. But is it good for the country? Now we got to pay for children. Look, this is going to take a lot of kids out of poverty. That's a good thing. But on the other side of the break, we're going to talk inflation and money printing and all this stuff. I mean, if we had tons of money in a rainy day chest and we decided to do this to lift kids out of poverty, I'm for it. But if we have no money and we're broke and we're borrowing money like crazy, I'm against it. But this starts July 15th. So if you have children, you're going to start getting direct deposits in your checking account. July 15th, I guess it's going to be the 15th of the month. Is that when they're going to do it? Looks like it. And every month going forward, you're going to get $300 a month if your kid's under 6 and $250 a month for every child over 6 and under 18. I got to call my wife. We have to have some more kids. I got to start all over again. That ain't going to happen. Biologically, it's not going to happen for both of us. Anyway, I guess we could adopt some children, right? So if you have children, this is a great thing for you. You love it. You're more dependent now on government than you ever were. Government's your daddy. We talked about that in press shows, the stimulus and all the money they want to give us and free college and pay off our student loans. And it's all buying you. Buying your allegiance, power over you. But who's going to turn away? $3,600 a year just for having a child, the government will give you. Right? So you have 4 children. I'm trying to do the math in my head. $14,000, $15,000 a year that we're going to pay each family that decides to have 4 children. Talk about incentives to have more and more kids. Well, government's going to pay for it, and the taxpayer is going to pay for your children. Why not? And just think about that. $300 a month the government will give you to feed your kids and do whatever you need to do. I guess $300 a month would feed a child and clothe them pretty much the whole year, right? Can you say socialism? Let's take a break. Top of the hour, 732-505-1160 is the call number if you want to be part of our program today. My name is Lou Scatigna. Don't go away.
This is a